Hi and welcome to Westpac London's end of day report for Monday, September the 5th. Look, US markets are closed today for the Labor Day holiday, but there's still plenty to talk about. Actually, the mood in equity markets was starting to deteriorate over the weekend, even before any market had actually opened. Of course, we had the ongoing fallout from the weak jobs numbers in the US on Friday, but in Germany, Angela Merkel, in her own home state, her party lost an election. One of the key issues in the campaign was about the sovereign debt crisis in Europe and Germany's contributions to the bailout funds. It's clear the German electorate are getting upset or angry about the extent to which they seem to be bailing out those profligate southerners. And with a court ruling on Wednesday expected to ultimately give more authority to Parliament in relation to these sorts of matters, and with the public anti-bailout, it's just throwing another potential spanner in the works in terms of how the sovereign debt crisis is going to proceed. In fact, there's a whole range of issues related to Europe this week that are really hotting up. I've made a few notes. I mean, today bond yields in Italy and Spain rose quite sharply, whereas bond yields in all other markets that were trading, such as in the UK and so on, actually continued to fall on this weaker global growth story that's coming through. But there's all sorts of speculation that the European Central Bank is maybe not buying as many bonds of Italy and Spain because of concerns about the backtracking on the austerity budget in Italy. We'll probably find out more about that on Thursday when we get the press conference following the ECB's interest rate decision, where surely they will not signal another interest rate increase later this year. Other factors causing concern this week, we're hearing that ratings agencies are thinking about a downgrade of Italy's credit rating. There's concerns about the Greeks, where on Friday they're looking to finalise the arrangements for this swap from shorter dated toxic debt to longer dated debt at favourable terms. Will they get enough take up of that proposal? All of these stories are starting to cause concerns that on top of the weaker US story, we're going to see the European sovereign debt crisis really back to the fore, and sooner rather than later. And remember too, of course, all the European players are back from holidays too now. So we've had a bit of a hiatus, but expect Europe to start to look pretty messy pretty soon. You're seeing it already in the stock markets today with, as I speak, at about 3:30 London time, so we've got an hour or more to go still in Europe. We've got the FTSE down 3.4% today, the French market's down 5.2%, the German market down 5.5%, was down actually 6% at one stage today, and the Spanish market's down 4.7% at the moment, just to give you a bit of a feel for the extent of the losses that are coming through related to these re-emerging European concerns. On the data front today in Europe, there was a survey by Centix of investor confidence. It plunged in August, it fell further in September. Hardly surprising given that none of the concerns in August have actually significantly abated. Commodity markets, some of them have been trading today. We're looking at losses in things like crude oil down 2.7%, as well as some Gulf supply coming back online. We're looking at the global growth story, pushing down the oil price, $84 a barrel at the moment. Copper prices down 1.7% as well. Gold's up 1.1%, $1,898 an ounce. Pretty much at the record high, I think now. I didn't check that though, but I think that's right. The other factor to mention too, Aussie dollar, it's slipping away. It's fallen a cent during the London session. It's just above 1.05 against the US dollar at the moment. Remember, late last week it was trading above 107, so it's hitting the Aussie dollar too. So it's all looking pretty gloomy. The futures market in the US markets aren't trading because of the holiday, but the futures market for the S&P 500 down 1.2% at the moment. Moving on to Australia, lots of data flow to watch for. We've got the current account figures for the second quarter coming out, and that'll include an estimate of the contributions from net exports to the GDP numbers, which are coming out later this week on Wednesday, of course. We're looking for rather than a big drag on export from net exports in Q1, we're looking for about a neutral sort of position in the Q2 numbers, with imports still strong, but exports coming back online after the flooding. And we've got figures on public demand as well. That adds into the GDP number, which we'll be finalising our forecast for shortly and after these figures. And we've got housing finance. And on top of that, of course, the Reserve Bank will put out its statement following its meeting. We don't look for any change in interest rates from the Reserve Bank, but we might see some signal in the statement that they're shifting towards more of an easing bias. Remember, our view at Westpac is that they'll be cutting interest rates before the end of this year, reflecting weakness in many of the interest rate sensitive sectors in Australia, and also, you know, the deteriorating global economic environment. All right, that's it from me for now. I'll be back tomorrow with a full report, of course, when with US markets open as well. Okay, speak to you then.